For the last decade, the digital gold narrative was incredibly profitable. But lately, the momentum of that massive narrative has started to lock up. Institutional giants holding billions in the asset continue to promise endless upside. Yet, if you look at the actual charts, you'll see a long, flat plateau. The thrilling returns speculators have grown accustomed to are drying up. Financial history shows us exactly how this happens. The diamond industry convinced the global market their stones were rare and strictly tied to love, completely masking the fact that they are common and industrially basic. When an entire market structure spends years printing money based on a single dominant story, investors stop checking the underlying math. They accept the flaws because questioning them feels too expensive. Elite investors don't rely on faith. They stress test their positions by looking backward. Charlie Munger popularized a mental model called the inversion principle. Instead of asking how a strategy will succeed, you ask exactly what steps guarantee failure. Applying that inversion to the crypto market forces us to look past the marketing. We have to identify the specific structural flaws that would cause the asset to collapse and determine why the smartest money in the room is willfully ignoring those warning signs. The current market is anchored by two incredibly comforting ideas. First, the belief that network congestion is actually a sign of pristine security. Second, the assumption that billions of dollars in corporate debt will act as an unbreakable price floor. Those two concepts are widely accepted as safety nets. In reality, they are the exact vulnerabilities required to trigger a systemic collapse. The incumbent network routinely charges exorbitant fees and can take up to an hour to confirm a single transaction. Adherents have reframed this friction. They choose to view the slow speeds and high costs as necessary proof of the network's immutability. A bank vault whose internal gears have rusted solid is technically secure, but you cannot use it to facilitate global commerce. A network that cannot process rapid micropayments is entirely cut off from integration with the massive data streams of the new internet, Web 3. This chart details the technical architecture of the BSV network to act as a massive, addressable superhighway for digital traffic. The operational data is stark. BSV clears payments in roughly 2 seconds for 1/1000th of a cent. Its carbon footprint per transaction equates to boiling a kettle, completely removing the massive energy bottleneck holding back the incumbent. In a global, data-driven economy, long-term survival demands high-volume, frictionless utility. A secure holding pen simply cannot process the traffic of the future. The second major vulnerability involves heavily leveraged institutional buyers. The market relies on the assumption that corporations holding billions of dollars in the asset provide a permanent, unbreakable base for the price. If the price flatlines for too long, those companies are backed into a corner and forced to liquidate to cover their debt. They cannot smoothly exit at the current market price. They have to dump billions of dollars into a surprisingly thin market order book that lacks enough buyers to absorb the hit. This creates a phenomenon called slippage. The massive block of sell orders violently chews through the available buy orders, dragging the price sharply down. That sudden drop automatically trips the stop-loss algorithms of thousands of other traders. Computers start selling blindly to prevent further losses, locking the market into a downward spiral. This chart maps out Phase 4, the Great Migration. When a speculative asset fails specifically because its technical limitations became a liability, fleeing capital often seeks refuge in the infrastructure that can actually handle the traffic. If the market realizes the gold narrative was a mask for congestion, it logically looks for the one network built for utility. This theoretical rotation into BSV is known as the flippening. Debt-fueled corporate reserves do not insulate the everyday investor from risk. In a liquidity crisis, those massive institutional bags act as the algorithmic trap that accelerates the crash. Elite investing relies on asymmetric risk management rather than emotional loyalty to a coin. It is the practice of positioning yourself so that a failure in one sector yields a massive, disproportionate gain for your portfolio. History is full of dominant networks that seemed untouchable until they vanished. We saw it with the rapid shift in consumer technology formats. Once an alternative proves its utility and scale to the broader market, the incumbent's network effect shatters very quickly. Executing the hedge is a straightforward mechanical move. Allocating a modest percentage of capital into BSV ensures that if the incumbent's leveraged debt fails, the subsequent flood of migrating capital multiplies your smaller BSV position, turning portfolio devastation into significant upside. Hedging your position isn't a betrayal of digital assets. It is a highly logical, mathematically sound insurance policy against a structural failure you cannot control. We are moving toward a highly integrated global economy. To support autonomous networks, instant data routing, and millions of daily micropayments, the underlying architecture must be fast, frictionless, and capable of infinite scaling. Take the time to look under the hood, search the web, review the technical specifications and network protocols of BSV, and consult with trusted financial sources to verify these market mechanics for yourself. This framework and structural analysis originated from the public research and macroeconomic modeling of Bruce Thompson, a longtime observer and investor in the space. Please note that Bruce Thompson is sharing market theories and observations. He is not a licensed financial advisor, and the information presented in this video does not constitute professional investment advice. When billions of dollars are concentrated into a single dominant narrative, your greatest asset isn't blindly following the crowd. Your ultimate store of value is independently doing the math.